Most UK limited company directors are sitting on a financial time bomb right now, and they have absolutely no idea. It is called Section 455. And if you have ever taken money out of your own company, money that was not salary, not a dividend, not a reimbursed expense, then this video is for you. Because here is what nobody tells you when you set up your limited company. The moment you take money from that company in any other way, you create something called a director's loan account. And if you do not manage it correctly, your company could be forced to hand HMRC up to 35.75% of every single pound you borrowed before you have paid a penny of personal tax. And today I am going to give you the full picture, the trap, the rules, and the anti-avoidance tricks HMRC already knows about. And I'll show you exactly how to use the director's loan account as the legitimate cash flow tool it is actually designed to be. Let's start with the basics. A director's loan account, or DLA, is simply a running record. It tracks every transaction between you, the director, and your company. It tracks everything that is not salary, not a dividend, and not a reimbursed business expense. Think of it like a tab. Every time you take money out of the company for personal use, even small things like a personal purchase on the company card, it goes on the tab. Your DLA becomes overdrawn. And an overdrawn DLA has a clock on it. Here is the rule from Section 455 of the Corporation Tax Act 2010. If your DLA is still overdrawn 9 months and 1 day after the end of your company's accounting period, your company must pay tax on the balance. Not you personally, your company. And right now, for loans made on or after April 6, 2026, that tax rate is 35.75%. Let me show you what that looks like in real money. You borrow £30,000 from your company. Your company's year end is 31st March. The 9-month deadline falls on 1st January. If you do not repay the loan by that date, your company now owes HMRC £10,725. That is 35.75% of £30,000. Paid alongside your corporation tax return. That is money out of your company's bank account for a loan you already spent. And here's the part that really hurts. That Section 455 charge is technically refundable. Once you repay the loan, your company can claim it back, but you have to wait 9 months after the accounting period in which you repaid it before HMRC hands it back. You could be waiting 18 months or more for a refund. Now, let me tell you about the second layer. Because Section 455 is not the only thing HMRC can hit you with. If your director's loan account exceeds £10,000 at any point during the tax year, even briefly, it is treated as a benefit in kind, unless you are paying interest at HMRC's official rate. For 2026-27, HMRC's official rate of interest is 3.75% per annum. If you have a £20,000 loan and you are paying no interest, the company must report a taxable benefit. You pay income tax on that benefit personally. The company pays Class 1A national insurance on it, and it goes on a P11D form. 2 tax hits on a loan you thought was just moving your own money around. So let me now talk about the thing every director tries, and why it does not work. You know the 9-month deadline is approaching. Your DLA is overdrawn. So you think, I will just repay the loan in December, bring the balance to zero, clear the Section 455 charge. Then in January, I will take the money out again. Problem solved. That is called bed and breakfasting. And HMRC saw it coming. The 30-day rule, which sits in the Corporation Tax Act 2010, says this. If you repay £5,000 or more to your company and then borrow £5,000 or more within 30 days, HMRC treats the repayment as if it never happened. The Section 455 charge remains on the original loan. The repayment is ignored for tax purposes. And it goes further than 30 days. There is also the arrangements rule. If HMRC can show that at the time you made the repayment, you already intended to reborrow, the repayment is still ineffective. They look at the substance, not just the timing. In the Autumn Budget 2024, the Chancellor tightened this further. Companies were found to be routing loans through related or group companies to reset the clock. That loophole is now closed. HMRC can and will look through the structure. So what do you actually do? Because here is what I want you to understand. The director's loan account is not inherently dangerous. Used correctly, it is one of the most flexible tools an owner-managed company has. Let me give you 5 legitimate strategies. Strategy 1. Know your year end and work backwards. The single biggest cause of Section 455 charges is directors who do not realize their DLA is overdrawn until it's too late. By that point, the 9-month clock is already running. The fix is simple. Review your DLA balance every single quarter. before your year end, not after. Strategy 2. Clear the balance with a dividend before year end. If your company is profitable and has distributable reserves, this is the most tax-efficient way. The dividend is credited to your loan account, wiping out the balance. No Section 455 charge, no benefit in kind. Done. But, and this is critical, the company must actually have sufficient retained profits to support the dividend. A dividend declared when there are no reserves is illegal. Strategy 3. Keep the loan under £10,000 to avoid the benefit in kind. If you need short-term access to funds, keeping the balance below £10,000 simplifies everything. Section 455 still applies if it goes past 9 months, but you avoid the P11D complication and benefit in kind hits entirely. Strategy 4. Use the DLA in credit. This is the part most directors never hear about, because it only applies if you have lent money to your company. If your DLA is in credit, there is no tax charge. In fact, your company can pay you interest on that loan. That interest is deductible for corporation tax purposes, and you receive it as income, taxed at your marginal rate. For early-stage directors who put personal funds into the business, this is a planning point that is almost universally missed. Strategy 5. If a loan is above £10,000, charge interest at the official rate, currently 3.75% per annum for 2026 to 2027. If you charge interest at this rate, the benefit in kind disappears. You receive the interest personally, declare it on your self-assessment, and avoid the P11D and NI hits. Now here is where your accountant earns their fee. Every single one of these strategies depends on timing and getting the paperwork right. A dividend that clears your DLA needs to be properly minuted. Interest on a director's loan needs a formal written agreement. These are not complex, but they need to be done. An accountant who is reviewing your DLA quarterly, not annually when the accounts are already overdue, is the difference between a well-managed tool and an unexpected 5-figure tax bill. Let me leave you with this. Section 455 is not a penalty for doing something wrong. It is a charge for not managing something correctly. The director's loan account has been part of UK company law for decades. HMRC knows it exists. They expect directors to use it. What they will not accept is directors using it as a permanent alternative to paying proper remuneration. And with the rate hitting 35.75%, that position is more expensive than ever. The trap is not the DLA itself. The trap is not knowing the rules. Now you do. If you want help reviewing your position, speak to a qualified accountant, ideally one regulated by ICAEW or ACCA, before your next year end, not after. Your accidental CFO. Subscribe for more expert breakdowns, because this is exactly the kind of thing your accountant should be telling you. And now you can have the conversation from a position of knowledge. See you in the next one.